Chewy stock price is down 77% off the high, and I'm going to discuss why I think that's a buying opportunity for long-term investors. The pet retailer's growth rate has slowed down considerably, and that's why the stock price has fallen by so much. But there are other factors at play here which I will discuss, so let's get into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So as you'll notice, Chewy stock price is down over 77% off the highs it reached in 2021. Of course, being an online retailer, the company benefited when people were staying home, spending money at home, and avoiding in-person shopping. When economies reopened, people started shopping at stores more often, and that hurt Chewy. Also, another factor hurting Chewy is people were returning some of the pets that they adopted during the pandemic. That was another trend that benefited Chewy. During the earlier stages of the pandemic, when people were spending more time away from other people, they adopted pets for companionship. But unfortunately, when economies reopened, people started returning those pets. That was something that surprised me considerably, and it surprised Chewy managers as well. Still, Chewy's management team has been one of the more effective management teams going into and coming out of the pandemic, something that's not easy to manage when your consumers' behavior shifts unprecedented as it did up and down. And so Chewy's revenue growth rate accelerated during the stay-at-home trend, upwards of 45% quarterly revenue growth. And then when economies started reopening and businesses started reopening and people started leaving their homes again, its revenue growth rate decelerated considerably, all the way down to just 3% in the most recent quarter. However, management said the second half of this year will be better than it initially expected, and next year it should re-accelerate growth as it expands to new markets in Canada and as people continue shopping with Chewy. One of the main factors at Chewy is customers spend more with Chewy as they mature with Chewy. So a customer in the first year won't spend as much money as a customer in the second year. So as Chewy goes forward, it adds more and more customers, but it also adds increasing spending from existing customers. So that tailwind also boosts Chewy's revenue overall. One of the more impressive factors about Chewy is the expanding operating profit margin. Over the last 5 years, you'll notice Chewy's operating profit margin has jumped from negative 9% all the way up to 0.15% in the trailing 12-month period. More than 70% of Chewy's sales are recurring. If you use Amazon, it's similar to the subscribe and save feature on Amazon, where you pick the item you want and how frequently you want it delivered. So you could say you want your dog food delivered once every month, and over 70% of sales on Chewy's site are those kinds of sales. Why is that important, and why am I bringing that up? Because it's easier to manage your business when you know what your customer wants to buy, when they want to buy it, and where you need to deliver it. It makes managing the business, inventory management, and logistics that much easier and less costly. Chewy has benefited from that, and management has used that to increase the percentage of sales and increase the profitability of the business. Looking at cash flow from operations, you'll notice a similar trend for Chewy in the last 5 years, 3.73%, and that's up from a little over 1% in 2019. Now, Chewy's business is not going to be a high margin business. It's a low margin recurring revenue business model. It ships these items. That's expensive. What it counts on is a lot of recurring sales and a growing sales market. The pet market in the United States alone is worth over $100 billion. Chewy's revenue is a little around $10 billion. So it's penetrated the market considerably, but it has a long runway to grow. Also, Chewy's planning expansion in Canada, like I mentioned earlier, so the new markets will add to its revenue total. In addition to new markets, Chewy is adding new products like insurance and other features that could have higher profit margins, as well as advertising, which has proven to be very lucrative for e-commerce companies like Amazon. I wouldn't be surprised if the ad revenue model will bring Chewy's profit margins higher. It has several drivers to boost profitability, and it's already shown excellent management of costs. That could be one reason why the analysts on Wall Street that are following Chewy stock expect it will grow its earnings per share by 77.5% each year over the next 5 years. Those factors I mentioned earlier are what will cause Chewy's profit margins to expand, as well as economies in scale, as has been demonstrated by other e-commerce players. Chewy focuses on one product end market, which is for pet parents, and that could give it a competitive advantage against Amazon, which focuses on a myriad of products and doesn't serve pet parents exclusively. You might say, why would a customer choose Chewy over Amazon? And it's because of that feature, because they cater to pet parents. They offer little distinct features for pet parents and for pet adopters that make it more attractive for them, right? Chewy is not going to crush Amazon in this category, but as long as it holds its own, that market opportunity might be large enough and Amazon might lose interest in a market when it's offering products in several different categories in several different parts of the world. Now, one of the metrics I talk about several times is the return on invested capital. And what I like to say, and it's a bit of an advanced finance metric. I teach this in my finance university course. It's to see that the return on invested capital is above the weighted average cost of capital. And if you don't know how to calculate the weighted average cost of capital, it's not a metric that's provided in most cases, but a general rule of thumb is if you have a return on invested capital that's above 10%, it's a good sign, and if it's moving upward, that much the better. Chewy's return on invested capital of 19.22% is well above that 10% benchmark that I look for, and it's moving in the right direction. And given its increasing earnings per share expectations over the next 5 years, I wouldn't be surprised if its return on invested capital continues to move higher. And it always helps when a company has an excellent balance sheet like Chewy does. $1.138 billion in cash and short-term investments and zero debt gives the company flexibility to capitalize on growth opportunities, use the money to generate interest income, or make an acquisition or two, whatever the company feels is opportunistic to utilize this billion-dollar hoard. And finally, the company's selling at the cheapest valuation it's been trading for going all the way back to 2021. When measuring by the forward price to earnings ratio, Chewy's forward PE of 24.8, it's the cheapest it's been going all the way back several years. So that stock price discount that I highlighted in the beginning of the video, where the stock is down 77% off the high, has created this attractive valuation for long-term investors. So for all these reasons I mentioned in the video, I think Chewy is an excellent buy for long-term investors. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.